Think about the word average. Most people say they are above average in just about every aspect of their life, whether they actually are or not. I mean, we've all done this at some point. Everyone wants to be above average. And the same thing happens when we're investing. We desperately want to beat the average market returns. After all, who wants to retire after 30 years of consistently investing in a boring index fund for a boring 7% inflation-adjusted annualized return? So in this video we will look at something called the efficient market hypothesis and analyze whether you can actually beat the market or not. But before that, real quick, I would appreciate it so much if you smash that like button. It really helps a ton and it just takes a fraction of a second. Thanks a lot, and now let's dive in. So in order to understand the efficient market hypothesis, we have to talk about some special terms. First, alpha, which essentially describes an investment strategy's ability to beat the market and is also often referred to as excess return or abnormal rate of return. For example, if a portfolio has a positive alpha of 3, it means that its return exceeded the benchmark index by 3%. If it has a negative alpha of 3, then it means that it underperformed the benchmark by 3%. The second term we have to talk about is beta, which is a measure of the volatility of a security or portfolio compared to the market as a whole, usually the S&P 500. For example, if the beta of a stock is 1.2, it means that it is 20% more volatile than the benchmark. Beta can also be negative, and that means that the stock is inversely correlated to the market benchmark. If the beta of a stock is 1, then it's highly correlated with the benchmark. For simplicity, roughly speaking, a security with a beta of 1.5 will have, on average, 1.5 the market return. There is also something called Jensen Alpha, which is basically risk-adjusted excess return because it also includes beta in its calculation. Alpha is essentially the holy grail of the investing world. In fact, maybe you've heard of a popular website called Seeking Alpha where people write about investment strategies that could potentially beat the market. So basically, the goal of all active portfolio managers is to generate alpha with diversification intended to eliminate unsystematic risk. That is the only reason you choose an actively managed fund over a passive one. The problem is that these actively managed funds have fees, and most of the time they eat into the profit generated by the fund, even leading to negative alpha. And this is where we get to the efficient market hypothesis. The efficient market hypothesis, or EMH for short, states that market prices incorporate all available information at all times, and so securities are always properly priced. Therefore, according to EMH, there is no way to systematically identify and take advantage of mispricings in the market because they do not exist. And if mispricings are identified, they are quickly arbitraged away. Historical returns of actively managed funds indicate that fewer than 10% of all active funds are able to earn a positive alpha over a 10+ year time period, and this percentage falls once taxes and fees are taken into consideration. In other words, alpha is hard to come by, especially after taxes and fees. Now, what's interesting is that while academics point to a large body of evidence in support of EMH, there are many voices who oppose it. For example, investors such as Warren Buffett have consistently beaten the market over long periods of time, which by definition is impossible according to EMH. Critics of EMH also point to events such as the 1987 stock market crash and asset bubbles as evidence that stock prices can seriously deviate from their fair values. But are there inefficient markets? There are definitely markets that are less efficient than others, meaning that asset prices do not accurately reflect their true value, and this happens mainly due to low liquidity. The more participants are engaged in a market, the more efficient we will become because there is more information affecting its price, if that makes sense. So to answer the original question, theoretically no, you shouldn't be able to beat the market consistently over long periods of time, but that doesn't necessarily mean it can't happen. However, the only way it can happen is if you take on more risk than by simply investing in the market as a whole through an index fund. Even so, there is a lot of luck involved in trying to beat the market. I mean, Wall Street Bets has the word bets in its name for a reason, albeit they are degenerates seeking crazy abnormal returns. Regardless of EMH's validity, I think it's pretty clear that your average Joe won't be able to beat the market consistently. So what can you do then? Well, my answer would be that investors need to realize the importance of just investing in an index fund passively because it's the only proven way to generate wealth over long periods of time. But that doesn't mean that you can't allocate a portion of your portfolio to individual stocks or other investments that carry more risk. The key here is how you balance your portfolio so that if your riskier investments fail, you won't become homeless overnight. But that's just my opinion. I want to hear yours in the comments below. Nothing you heard here was financial advice. Thanks for watching, and don't forget to check out this video next for more valuable insights.